Hello and welcome to the second part of video recordings on CVP analysis, break-even point and short-term decision making. In the first video we understood the principles of CVP analysis. In this video we are going to be applying those principles to questions or problems. So the question we are looking at is called Thanos Limited. Please note through Thanos Limited together, generate necessary calculations and analysis for each of the part of this case study Thanos Limited. Okay, the question has three scenarios. Okay, three different scenarios, so three different types of short-term decisions we are looking at in these three scenarios. We'll do the calculations together, we'll do the numerical analysis together, have a bit of discussion, and then your job is to conduct further reading, research and write the analysis. Okay, let's dive into it. So Thanos Limited, the first scenario. Thanos Limited company, a medium-sized company manufacturing, supplying smart and affordable computing tablets, and the costs given for the current business are as follows. Cost and income, of course. Selling price is £40, so they're selling tablets for £40 each. Direct material for each unit of tablet £15. Direct labor is £5, and other variable cost to produce one unit is £7. Fixed cost for the entire business is 140,000. Budgeted sales for next year is 20,000. What is happening now is that an overseas distributor called Apex Company has approached TL with a unique order, TL being Thanos Limited. They wish to place an order of 8,000 tablets. Brilliant, quite large order, but at 25% discount on the original price. Oops, have a discount. Additional variable cost will be £3 per unit. Although TL has spare production capacity, Apex wants this order to be prioritized and completed as quickly as possible. Requirement: advise TL whether to accept one of contract from Apex and clearly show your workings. So we'll do the workings together. Your job is to advise TL in written, 90 words. Okay, make sure you provide references. Right then, let's dive into it. Minimizing this, I'm providing this spreadsheet on the Moodle together with the question so you can work through the scenario with me. All right, so pause the video at this point, get the spreadsheet, get the question, and let's work it together. So first of all, what we want to do in this scenario is just work out what the profit is like currently without this offer. So selling price, as we know, is 40. Variable costs are 15 direct material and 5 for direct labor. So current contribution per unit is £20. Each unit of tablet gives £20 contribution. So if we turn it into total contribution, which is 20,000 units of tablets into £20 each, that is £400,000. Okay, right, so we haven't yet found the profit. To find the profit, we still need to deduct the fixed cost of 140,000, and that's how we find the profit, current profit of 260,000. Right now we are a profitable business. Accepting this offer, whether it is going to generate loss, whether it is going to generate profit, we don't know. The decision rule over here for one-off contracts, as we said in the first video, should be if the one-off contract provides positive contribution solely on the financial basis, not talking about other non-financial factors like other customers not being happy for us if we accept this offer, not talking about that, just the financial, on the financial grounds. If the order provides positive contribution, we should accept the offer. Okay, because the positive contribution will work toward recovery of the fixed cost, and by the looks of it, our regular business has already recovered the fixed cost. So any kind of positive contribution the new Apex order provides will be purely profit because all the fixed costs are recovered. Okay, and let's just quickly work out the break-even point for the current number of units, current number of units that we are selling for the business. So break-even point, remember, break-even point is where is no profit, no loss, or where the fixed costs are exactly equal to the contribution. So can I do this to work out break-even point? If I take all fixed costs and divide it by contribution per unit, yeah, I get 7,000 units, which means if I sell 7,000 units and each unit provides £20, I will have recovered £140,000 worth of fixed costs. Yeah, at this point, no profit, no loss. If we sell anything more than that, we'll make profit. So how many we are selling right now? You know, it's 20,000 units we are already selling, so we are already in profit margin of safety region. So I already have a hunch that we can accept Apex offer as long as it is a positive contribution providing offer. So for Apex, we know Apex wants the tablets for 25% discount, so £40 exactly multiplied by 75%, so removing 25% from 40, and that should give us 30. Okay, so we are going to be providing these tablets for £30. Direct material, as we know, is 15. Direct labor is 5. Plus the question says, this problem says that we will incur further £3 worth of variable costs. Well, it could be anything really, for say branding or different kind of packaging or any kind of extra material that the offer provider wants us to use. So we are going to incur £3 extra. If we do, we are still left with £7 worth of positive contribution. Okay, so because it's a positive contribution providing offer, we should accept the offer. How is it going to look? So if we work out total contribution from the offer is 8,000 units, yeah, into £7. Let's put a pound sign. That's £56,000. Yeah, we are already generating contribution from regular business of 400,000, going up, so you can see 4,000. Yeah, that is the additional contribution, 56. So altogether it's 456,000. Our fixed costs are not going to change. They're going to remain fixed of 140,000. Even because of the order, if we had to borrow an extra machine, rent an extra machine, if the fixed costs are going to go up, they're not going to go up hugely, and still we will be making profit. Okay, so profit with the offer is clearly 316,000, clearly higher than current profit of 260. So we should accept the offer. All right. So that was the first scenario. Now your job is to do the analysis and identify any kind of critical factors, certain critical factors, such as not critical factors but criticisms really for the offer. If we accept the offer, what could go wrong really? Our existing customers may not be happy. If we are providing them less discount than the current offer, then they may not continue to do business with us, right? For example, there could be other factors as well. We don't want to spill the beans right now. It's your job to go and find it. Okay, now looking at the second scenario, here we have TL looking to let's just highlight it so we know. TL is looking to outsource his accounts department for over 6 months now. A firm, Creative Accountants, nice name, CA, has approached TL and offered to provide the service for £15,000. All right, okay. So it's a decision about whether to outsource a function or not. TL ascertains the following costs are currently incurred internally, clerical labor 7,000, supervisory labor 6,000, variable overheads 3,000, fixed overheads 5,000. Now we need to advise TL whether to outsource the accounting function. Clearly show your working. So again, we'll be doing the workings together. Your job is to provide the advice in 70 words, provide references. Now for this type of decisions, what we need to compare is the cost of outsourcing, which is 15,000 in this case, with any specific cost related to the function, internal costs related to the function that we are planning to outsource. Because what's going to happen if we outsource that function, those costs will no longer exist. Okay, we can write off those costs, we can ignore those costs. So only those type of costs should be compared with the outsourcing cost. In this case, we have clerical labor. Clearly, we are going to stop clerical labor. We don't need that. Supervisory labor, debatable. You can treat it as a fixed cost, which is that even though you outsource the department, you may have to continue to pay expenditure or wages to the people who are supervising. If their salary is variable, then yes, it can be ignored. But if they are not variable costs, if it is not variable costs, if it is fixed costs, you will still incur those fixed costs even if you outsource the department, in which case that is an important cost. Then other variable costs, yeah, clearly they will go as a result of outsourcing. And fixed overheads, 5,000, that's the company-wide overheads and therefore not specifically related to accounting function. So only the costs which are related to accounting function are going to be considered here, okay, if they are variable costs. So let's have a look at this. So scenario 2 here. So first thing we are going to consider is cost of outsourcing, that is 15,000. Okay, then we are going to be comparing that 15,000 with cost of keeping the accounting function in-house. If we keep the function in-house, how much is going to incur? So I've created two alternative scenarios over here. The first one is that we assume that the supervisory labor is variable cost. If it is variable cost, then how much is the total cost of accounting function? So clerical labor, 7,000. Supervisory labor, we are considering this as a variable cost, 6,000. And variable overheads is 3,000. So the total is 16,000. If that's the case, clearly 16,000 is greater than cost of outsourcing, and therefore we should outsource. If we keep it in-house, then it's going to be more expensive. Now if we assume supervisory labor is fixed cost, which means that whether or not you outsource the function, you'll still incur those costs. We must not include this in our calculation. So in that case, we'll only have two types of costs. The one is the clerical labor of 7,000 and the other one is variable overheads of 3,000. Altogether is 10,000. Sorry, it's not right. 10,000. Now if we keep this in-house, then of course it will cost us 10,000, because remember the supervisory labor is the cost, the type of cost you will incur whether or not you outsource. So if it is clearly in this case, it would be cheaper to keep the function in-house, right? In which case we'll reject the offer. So yeah, two different scenarios. Now apart from this, also think about the issues that could arise as a result of outsourcing. Are the service reliable provided by the creative accountants? What will be the changes in the price offered? Right now they are saying 15,000. Could there be an increase in future? Is that acceptable? What other factors would you consider? Think about those and include those in the analysis. Okay, now moving on to scenario number 3. That is very, very interesting. So here we have this one. TL, parent company. TL's parent company, Bristol Tax, BT, is large independent supplier and retailer of electronic goods. It has 3 retail shops operating in Bristol, Gloucester and Bath. The business in general is profit making, although Gloucester branch is currently incurring losses. BT's management is considering to close the Gloucester branch with immediate effect and open a new branch in London instead. Okay, the new branch will take approximately 1 year to be completed. 1 year to be completed. A summary of next year's budget is given below. So we have sales for each of the branches and the total sales, then direct material for each of the branches, total, wages and other variable costs, 3 branches total, fixed costs 3 branches and total. We need to advise BT's management whether to close the Gloucester branch before the London branch is fully functioning. Okay, so it is going to take a year for a London branch to open. For this 1 year period, should we close down Gloucester branch? Okay, clearly show your workings, provide analysis, 90 words. Okay, that's your job, the analysis. We'll do the calculations together and do a bit of discussion together. Now the idea over here is that in short term, the fixed costs cannot be avoided. Okay, so even if we close down Gloucester branch, the fixed cost of 30,000 will be there. Okay, keeping Gloucester branch while the London branch is being built and for a year, and then after that it is going to be fully functioning. After that we can close the Gloucester branch, but if we close it now, it may stop providing the positive contribution it is currently providing. Okay, if it is providing positive contribution, which means it is working towards paying off the fixed costs. Yeah, if we close the Gloucester branch and then it won't provide that positive contribution, in which case we'll have to suffer this 30,000 on top of the other fixed costs for the business, Bath and Bristol. Okay, so is it a wise idea? Let's have a look. Let's create 2 scenarios. In one, we'll consider if we keep the Gloucester branch. So this is scenario 3, and 2 alternatives. First one is we keep the Gloucester branch. Okay, then let's I'm not going to type in the so what I've done is created a new table in which we have sales, direct material, wages, and the variable overheads. Then I've added the contribution row. Okay, then fixed cost, and then profit. So we can clearly see if the Gloucester branch or any of the branches for that matter provide positive contribution or not. I'm going to copy and paste figures from here. All right, so let's do this up to the variable costs. So sales, direct material, and wages and other variable overheads for 3 branches. Leave the total out. So this 3 placed here. Okay, and let's get rid of any kind of borders. So what's happening is that once you have put in those figures, yeah, it is doing all the calculations for you. All right, so currently Bristol branch provides contribution of 93, Gloucester branch 25, and Bath is 60. Okay, now let's copy and paste fixed costs. Oops, wrong one, this one, 30,000. Okay, there you go. Okay, again removing the borders. All right, so now what we can see is let's pay attention to the Gloucester branch. Right, Gloucester branch currently provides positive contribution of 25,000. Positive contribution. That means it works towards paying off this fixed cost for the branch, which is 30. That means we are then left with profit loss of 5,000. If we close the Gloucester branch, okay, then the contribution will be 0 and the fixed costs are going to be still there for the entire year, in which case the loss is going to be 30,000. Are you with me? So all right, so what we'll do is now copy paste all the figures into the second alternative, which is to close the Gloucester branch. So let's copy the entire table with all the figures only and paste it here. Okay, paste it here. So it's exactly the same, just copy and paste. Now what we'll do is remove, if we close the Gloucester branch, there won't be any income, 0. There won't be any variable costs, material will be 0, and wages and other variable overheads will be 0. Okay, so no income and no variable costs. Contribution will be 0, in which case there won't be profit, but there will be a loss of 30,000. Okay, now if you compare that with that, you can clearly see that keeping Gloucester branch is better. And from the overall company point of view, right now, if with Gloucester branch being carried on until end of first year, you're making profit of 88,000. Okay, in this case, in this alternative scenario, the profit will drop by 25,000. So short term, the season, if you are going to close a season activity, think twice before doing it if the activity is providing positive contribution. Okay, so the season over here is to keep the Gloucester branch solely on the financial basis, but there could be other non-financial factors as well. Interesting. Can we say with certainty that the fixed costs are going to remain this much for the next period? Okay, also, can we say with certainty that this is what the income is going to, and the variable costs are going to look like for the forthcoming year? It is possible that because Gloucester branch is already loss making, there is a reason behind it. There is not enough sell, and the sales may decline further, in which case there may not be a positive contribution. Okay, it may be a loss making, negative contribution, and that will then not be advisable to keep the Gloucester branch. Okay, so that's something like that you need to do in the analysis. Brilliant. So those are the three scenarios we wanted to look in our video. So I hope you enjoyed it. Okay, and make sure you complete the assessment task. If you have any queries, drop me an email. Happy to answer. Thank you very much.